10 Golden Rules for Beginner Long-Term Investors. Before we start, let me be clear. This is not financial advice. This is education to help you build a foundation for long-term investing. Most beginners fail at investing because they chase hot stocks, panic during downturns, or pay too much in fees. But you don't have to make those mistakes. If you follow proven rules backed by decades of data, you can succeed. These are the 10 golden rules for beginner long-term investors. Rule 1. Start early. Time is your superpower. The earlier you start, the less money you need to invest. That's because compounding does the heavy lifting over decades. Your money earns money, and then those earnings earn more. If you invest $100 a month from age 20 to age 60 at 8% returns, you'll end up with about $300,000. Wait until age 30 to start, and you'll have less than half that amount. The rule of 72 shows how fast money doubles. Divide 72 by your return rate. At 9%, money doubles every 8 years. That's why starting early is your superpower. Even small amounts now grow into big amounts later. Rule 2. Stay invested. Don't try to time the market. Everyone wants to buy low and sell high, but history shows almost nobody does it consistently. Even professional fund managers fail. The S&P 500 has returned about 10% a year since 1928, but if you miss the 10 best days in the market over 20 years, your returns would be cut in half. Missing just 20 of the best days, and you made almost nothing. JP Morgan studied this from 1999 to 2018. Investors who stayed fully invested earned over 5% annually. Those who missed the best 20 days earned 0. The lesson is clear. Time in the market beats timing the market. Rule 3. Automate contributions. Consistency wins. Most investors lose not because of bad markets, but bad habits. Dalbar research shows the average investor earns about 6% a year, while the market does nearly 10%. Why the gap? Because people buy high when they're excited and sell low when they're scared. The fix is automation. Set up automatic contributions every month. This removes emotion and keeps you consistent. This is called dollar cost averaging, and it means you buy more shares when prices are low and fewer when prices are high. Over decades, it smooths out the ups and downs. Rule 4. Keep costs low. Fees kill wealth. Fees may look small, but they're devastating over time. A 1% annual fee can reduce your portfolio by more than 30% over 30 years. That's hundreds of thousands of dollars lost. Morningstar found that cost is the single best predictor of fund performance. Low-cost index funds beat most actively managed funds. The SPIVA scorecard shows 90% of active managers underperform over 15 years. Why pay more for less? If your fund charges more than 0.2%, it's too expensive. Index ETFs often cost 0.05% or less. Keep costs low and let compounding work for you, not against you. Rule 5. Diversify. Don't bet the farm. Betting on one stock feels exciting, but history shows it's dangerous. Companies can and do fail. Enron collapsed in 2001. Lehman Brothers collapsed in 2008. Shareholders lost everything. But the market as a whole has always recovered. Since 1928, despite dozens of crashes, the S&P 500 still averaged nearly 10% returns. That's because winners outweigh losers. Diversification is your insurance policy. Buy the whole market with index funds and protect yourself from disasters. Rule 6. Control emotions. Patience pays. The market drops 10% almost every year. It falls 20% or more about once every 6 years. But every time, it recovers and goes higher. In 2008, the market fell more than 50%. By 2013, it had fully recovered. By 2018, it had more than doubled. The danger isn't the crash, it's your reaction to it. Selling in fear locks in permanent losses. Dalbar's study proves it. The average investor underperforms because they panic at the wrong time. Patience is rewarded, panic is punished. Rule 7. Reinvest dividends, fuel for growth. Dividends are a hidden power of investing. Since 1930, dividends made up about 40% of the S&P 500's total returns. Reinvesting them supercharges compounding. Here's an example. $10,000 invested in the S&P 500 in 1960 grew to about $200,000 by 2020 without dividends. With dividends reinvested, it grew to over $2.5 million. The rule is simple: reinvest dividends instead of spending them. Rule 8. Protect against inflation. Cash loses value. Inflation is a silent thief. $1 in 1990 is worth less than 50 cents today. That means cash loses power every year. Even at 3% inflation, money loses half its value in 24 years. Sitting on cash guarantees you fall behind. Stocks historically return about 10%. Bonds about 5%. Cash? Barely 1%. The rule is simple: don't let cash sit idle. Invest it in assets that outpace inflation. Rule 9: think long term, decades, not days. Markets rise and fall in the short term, but over decades the direction is up. In 2000, the dot-com bubble burst and markets fell nearly 50%. It took 7 years to recover. In 2008, the market dropped 50% again, but by 2013 it had fully recovered, and by 2018 it had more than doubled. Even in 2020, when COVID caused a 34% drop, recovery took just 5 months. Short-term pain has always led to long-term gain. The rule is clear: think in decades, not days. Rule 10: keep it simple, don't overcomplicate. Beginners often think more complexity means better results, but the data shows the opposite. Fidelity once studied which accounts had the best returns. The answer? They belonged to people who forgot they even had accounts. Why? Because they didn't trade, didn't tinker, and didn't panic. They just let compounding work. The rule is simple: keep it simple. Buy, automate, and wait. These are the 10 golden rules of long-term investing. Start early, stay invested, automate contributions, and keep costs low. Diversify, control emotions, reinvest dividends, and protect against inflation. Think long-term and keep it simple. Follow these rules and you'll give yourself the best chance at success. The data proves it. The market rewards discipline, not drama. It punishes panic, but it pays patience. And it always has. And one last reminder: this is not financial advice. This is education to guide your journey.